Hello, class. So I'm going to continue the discussion, but this time we're going to discuss the super variable costing. So as you can see from accounting tools, so super variable costing only considers total variable cost to be part of the cost of inventory. But this variable cost will typically includes only the direct materials as part of the cost of inventory. So meaning for direct labor, for variable manufacturing overhead are all considered fixed. So from our previous discussion, so I said before that sometimes it's hard to estimate the variable manufacturing overhead, or if you want to estimate the variable manufacturing overhead tends to be small or immaterial in amount. So therefore, many firms considers all manufacturing overhead as fixed only. So they just ignore uh, the variable portion of the manufacturing overhead. Aside from variable manufacturing overhead, the same with direct labor. I told you before that in reality, some of labor costs tend to behave as cost due to contractual arrangement or obligation through law or its management policy. So therefore, aside from variable costing, we have what we call the super variable costing, wherein only direct materials are considered variable costs and product costs, and the rest of the costs are uh, considered as fixed costs and recognized as part of your period cost. So as you can see in the screen, so the super variable costing is also called the throughput costing. Ayan. So to discuss on how to solve a problem for super variable costing, let's discuss problem 4 in our handout. So I'm going to read the problem. ABC company manufactures and sell one product. The following information pertains to each of the company's first year of operation. So we have variable cost per unit, which only includes direct materials, that is $12. The fixed cost per year, we have direct labor, 500,000. So as you can see, the direct labor is considered as fixed costs in this particular problem. Then we have fixed manufacturing overhead and fixed selling administrative expenses for 450,000 and 180,000 respectively. The company does not incur any variable manufacturing overhead costs or variable selling and administrative expenses. During its first year of operations, ABC produced 50,000 units and sold 40,000 units. So therefore, for first year of operation, so for uh, year one, so we have production, and our production is 50,000 units, and our unit sold is 40,000. So therefore, we have ending inventory equal to 10,000 units. Yan. Uh, to continue, during its second year of operations, it produced 50,000 units and sold 60,000 units. So for year two, our production is 50,000 units and sold 60,000 units. So therefore, our ending inventory is zero. Uh, so included in this 60,000 is the 10,000 of beginning inventory for year two. So this is for year one and this is for year two. Yeah, for year two. The selling price of the company's product is $50 per unit. For the requirement, so number 12, assume the company uses super variable costing, compute the unit product cost for year 1 and year 2. So I'm going to transfer to the note. So for that's problem 4. And for number 12, so for number 12, hmm, so for number 12, so they are asking for product cost using super variable costing, or this is throughput costing. And I told you before, or I told you a while ago, that for super variable cost or throughput costing, we only recognize direct material costs as our product cost. And if you go back to the problem, the direct materials, or the only variable cost is direct materials, and that is $12 per unit. So if that is the case, our answer is uh, $12 per unit. So this is the same for year one. This is for year one and year two already. Is $12. Ayan. So next, for number 13, so let's look at the requirement. Let's go back to the problem. So for number 13, assume the company uses super variable costing, prepare income statement for year one and year two. So using super variable costing or throughput costing, so they're asking for income statement. And that is for 2 years. So we have year one, we have income statement for year one. Ayan. So since this is income statements, we're going to start with sales. And sales is just the unit sold multiplied by the selling price. And if we go back to the problem, the units sold for year one is 40,000 units, this one. And our selling price is $50 per unit. So for sales, this is 40,000 units multiplied by the selling price, and that is $50. So the product will be 2 million. So we have $2 million. Now we need to compute for the, take note, this is variable costing. So we are following the same format as we have discussed with the regular variable costing method. So we have variable cost of goods sold, and this variable cost of goods sold will only includes direct materials. And since this is variable cost, remember the behavior of variable cost is constant per unit. So therefore, to compute for the total variable cost of goods sold, just multiply the unit sold, which is 40,000 in this example, multiply by the variable cost per unit, and this is $12. So where did I get the 12? So this one. Yeah. 12. So therefore, the cost of goods sold for year one is 480,000. Ayan, 480,000. And since there is no variable manufacturing overhead, just deduct sales, just deduct variable cost of goods sold from sales, then you will get the contribution margin. So this is contribution margin, or our CM. And this is for 2 million minus 480,000. So that will give us 1,520,000. So after the contribution margin, just deduct all of other expense that are considered fixed. Remember, for super variable costing, except for direct materials, all expenses or all other costs are recognized as period costs and fixed expenses. So for this problem, we have direct labor for 500,000 and fixed manufacturing overhead for 450,000 and fixed selling and admin expenses of 180,000. So I'm going to deduct direct labor, which is fixed for this problem, and that is 500,000. So minus ako dito ng 500,000. Another one for fixed manufacturing overhead, and that is for 450,000. And lastly, for fixed selling and admin expense, uh, and that is 180,000. Yan. So after deducting all of the fixed expenses to the or from the contribution margin, so we will arrive at operating income or income from operation, and this is also our earnings before interest and taxes, and that will be 390,000. Yan. So this is our income for year 1, 390. And next is year 2. So for year 2, actually the same procedure, although there will be a change from the given, because in year 2 the unit sold amount is 60,000, as you can see in the problem or from the problem. So we have sales, and this is 60,000, the unit sold multiplied by the selling price, and that is 50. So that will total to 3 million. Then deduct the variable cost of goods sold or the product cost. So we have the variable cost of goods sold, and this is the unit sold of 60,000 units multiplied by the direct material cost per unit, and it is 12. So that is 720,000. There is no variable selling and admin expense, so therefore the difference between sales and the variable product cost is the contribution margin. And the contribution margin is 3 million minus 720. That's 2,280,000. Then we need to deduct all of the other costs which are considered fixed costs for this problem. Sorry for that one. And that is direct labor. So we have direct labor, that is 500,000. 500,000, and also the fixed manufacturing overhead, and that is for 450,000, and also the fixed selling and admin expense, that is 180,000. So if we deduct all of the fixed costs, so this is fixed costs from the contribution margin, we will arrive at the operating income, and this is also your EBIT, and that is 1,150,000. Yan. So therefore, for year 1, our operating income is 390,000, and for year 2, the operating income is $1,150,000. So we're done with number 13. So this is number 13. So we're done with number 12, which is $12, and number 13, which is the uh, net income from what we have computed a while ago. No? The 390,000 for year 1 and 1,150,000 for year 2. Now, another requirement, number 14. So we have uh, three more requirements for this problem. So number 14, according to the problem, assume the company uses a variable costing system that assigns $10 of direct labor costs to each unit produced. So this time, the direct labor cost is not anymore fixed cost, because this is the regular or the normal variable costing system, wherein the cost of our inventory or the product cost will be your direct materials plus direct labor plus variable. plus the variable manufacturing overhead. So this is for regular variable costing system. So for this problem, we're going to ignore the direct labor cost because direct labor rate of $10 are provided for us for number 14. So according to the problem, compute the unit product cost for year 1 and year 2. So let's answer that one here. So this is number 14, and this is for variable costing, not super variable costing. And the product cost will include direct materials plus direct labor plus variable manufacturing overhead. Therefore, the product cost for year 1 and year 2 will include the $12 of direct material cost plus the $10 for direct labor. Take note, there is no variable manufacturing overhead. So therefore, the total product cost for year 1 and year 2 under the regular variables costing method is $22. Yan, $22. So that is for both year 1 and year 2. Next, number 15. So we're done with number 14. Number 15. Assume the company uses a variable costing system that assigns $10 of direct labor cost to each unit produced. Prepare income statement for year 1 and year 2. Yeah. Oh, let us also answer number 16, which is just the reconciliation of super variable costing and the variable costing net operating income. So as you can see, for super variable costing, what is considered as product cost is the direct material cost per unit, while for the super variable costing, for regular variable costing, the product cost will include the direct materials, direct labor, and variable manufacturing overhead. Since we don't have variable manufacturing overhead, the only reconciling item between super variable costing and variable costing are the direct labor or is the direct labor. In reality, if there is variable manufacturing overhead, both direct labor and variable manufacturing overhead are reconciling item for or between variable costing and super variable costing or throughput costing. But since we don't have variable manufacturing overhead in this problem, in this particular problem, the only reconciling item is direct labor. So the cost of the difference between the two net income is only the direct labor in the ending inventory or beginning inventory. Now, if that is variable costing versus the absorption costing, the reconciling item is only the fixed cost on inventory balance, beginning or ending balance uh, between the absorption costing and the variable costing. Ayan. That is how are we going to reconcile. But first, we need to uh, prepare the income statement using variable costing. Take note, this is the regular or the normal variable costing method. And we have for year 1, so the same procedure. So we have sales. And this is the number of units multiplied by the selling price per unit. So for year 1, our sales is 40,000 multiplied by 50. Yan. So this is 2 million. Then we need to deduct the variable cost of goods sold. Take note, this will include direct material plus direct labor plus variable manufacturing overhead. But we don't have variable manufacturing overhead. And this is the unit sold, which is 40,000 multiplied by the product cost under variable costing, and that is 22, including direct labor. So multiply by 22. So it will give us 880,000. There is no variable selling and administrative expenses. So therefore, the difference will give us the contribution margin, and that is 2 million minus 880,000. So this is 1,120,000. And after computing for the contribution margin, we need to deduct the fixed costs. And we still have the fixed manufacturing overhead. Sorry. The fixed manufacturing overhead. And that is 450,000. So minus 450,000. And also we have fixed selling and admin expense. And that is 180,000. So therefore, the operating income or the earnings before interest and taxes under variable costing will give us 490,000 for year one. So this is for year one. Now, how are we going to reconcile? So that is from super variable. So we have super variable net income. This is also the throughput costing. So our super variable net income for year one, that is 390,000. Yan. So this is 390,000. Take note, we are from super variable, so to the variable costing net income. So the only cost, the cost of the difference between the two net income is just the direct labor cost and the variable manufacturing overhead for both the beginning inventory and the ending inventory. So we need to analyze. So if we compare the beginning inventory under uh, super variable net income is understated as compared to the beginning inventory of variable net income. Why it is understated? Because in regular variable costing, we include direct labor and variable manufacturing overhead as part of product cost. But for super variable net income, we only include the direct material costs. The direct labor and variable manufacturing overhead are considered as fixed costs or period costs under the super variable net income. So therefore, that will uh, cause the difference between the two net income. And if we compare the beginning inventory of super variable net income compared to variable costing net income, the beginning inventory is understated because of direct labor and variable manufacturing overhead. If that is the case, if the beginning inventory is understated, the goods available for sale will be understated also, and the cost of goods sold will be understated, and the net income will be overstated. So therefore, from super variable to variable net income, we need to deduct the uh, take note, the direct labor cost and the variable manufacturing overhead of the beginning inventory from the super variable net income. However, for this problem, the beginning inventory is zero because that is the first year of operation. But for the first year of operation, we have ending inventory, and the ending inventory is 10,000 units. So this is 10,000 units. Ayan, 10,000 units. Why 10,000? So let's go back to the problem. Uh, For year one, the company produced 50,000 units and sold only 40,000 units. So we have 10,000 units in ending inventory. And these 10,000 units under super variable costing system is also understated. Why understated? Because the variable costing includes direct labor and variable manufacturing overhead as part of product cost or as part of the cost of these 10,000 units of inventory. But for super variable, it does not include it does not consider the direct labor and variable manufacturing overhead as part of these 10,000 units in ending inventory. So therefore, this is understated. If this is understated, there is no effect to the goods available for sale, but the cost of goods sold will be overstated, and therefore your net income will be understated. If that is the case, to convert the super variable costing net income to the regular costing net income, we need to add, so this is deduct, this is add, so we need to add the direct labor and variable manufacturing overhead or the conversion cost of this 10,000 in ending inventory. Now, how much is the direct labor cost? So according to the problem, the direct labor cost is 10. So this is 10 for direct labor, that is 10, but 0 for variable manufacturing overhead. So we just need to multiply the 10,000 units by the direct labor cost per unit, which is $10. So 10,000 units multiplied by $10, it will give us 100,000. So 390,000 plus 100,000. The variable costing or the regular variable costing net income is 490,000. Ayan. And this is the same. Ayan. Okay, next. For year 2. For year 2. So for year 2, so we have sales again. We have sales, and this is 60,000 units multiplied by the selling price, and that is 50. So therefore, the product is $3 million. Then we have the variable cost of goods sold, which comprise of direct materials and direct labor. And this is 60,000 units multiplied by 22. And that is 1,320,000. There is no variable manufacturing overhead. So I will just pause.